It's really a privilege to be here for the 60th birthday party of the Bundesbank. This panel is a bit different, I think, from the previous two. We move now from the consideration of what I would call short or medium-term monetary policy issues, things related to conventional and unconventional policy, as well as financial stability policy, to much more long-term structural issues related to the financial system and to technology. Much of the focus of the discussion of financial technology or fintech has been on how it changes private sector financial relationships, digital wallets for retail payments. I love paying for things with my mobile phone. It's one of the most exciting things the innovations that I have. But of course, I love my phone, so a little too much probably. But then we also are, I think, on the verge of having comparison and switching tools to manage accounts for individuals. We have robo-advisors for asset allocations. We have peer-to-peer lending platforms for credit. Those are growing. We have for some time, for better or worse, had high frequency and algorithmic trading. And then now we're looking at forward to changes in payments, clearing, and settlement technologies. Insiders, I think, in the central banks and the supervisory authorities have been talking about some of these issues from the point of view of their impact on central banks for a long time. But that has not been something, I think, that has been quite as much in public view. So I think I welcome this particular panel to try and bring some issues into public view. Now, it's important, I think, to keep in mind that central banks do a number of things. People outside of this room don't, here everybody understands this. People outside of this room understand much less. The fact that a central bank is, in fact, an operational bank. And it offers banking services to governments, and it offers banking services to banks. And it's also, in that way, then entrusted with a number of activities whose objective is to improve the infrastructure of the financial system. So, but I think that we should be asking a number of questions about financial technology going forward. I'll list a couple. How will technology change the ability of central banks to deliver on their traditional objectives, price stability and financial stability? Will operational policy for central banks have to change in material ways? Or is it just going to change the way in which central banks are delivering the services that they already supply to the governments and the commercial banks that they are serving? Of course, there's been continuous financial innovation on a lot of these dimensions already, but those innovations have been things that haven't really been that noticeable from outside of the central bank. Now, President Weidmann, in his introductory remarks, offered views on three things. He mentioned private monies. Will these supplant central bank issued money? He mentioned the access that there could be to the central bank balance sheet. What would happen if everyone had an account at the central bank? And he mentioned changes in the payments system and the question of whether or not central banks can or should be exploiting new technologies to improve efficiency and access. I guess he expressed his skepticism that private monies would make any material inroads, concern about the consequences of offering universal access, and expressed, I think, somewhat of a positive view of the official sector's work to improve payment systems. But it's very early days. There's still much that we don't know about how technology is going to deliver financial services in the future. And there's a little consensus, I think, on what the role of the central bank will and should be in both adapting their own internal structure to technology and in shaping how technology is in using regulatory tools and their influence to shape how it is that technology actually evolves in the private sector. We're very fortunate to have a panel of distinguished experts who have thought about and worked on various aspects of all of these questions. First, to my far left, we have Claudia Buch, who is the vice president of the Bundesbank. And among other things, she's responsible for general financial stability. That's what it says on the website. I just report on that. But Claudia is, in addition to being in the Bundesbank, is a member of the FSB's Standing Committee on the Assessment of Vulnerabilities. She's an active participant in the Committee on the Global Financial System, and prior to joining the Bundesbank, had a distinguished career as an academic. Next on my left is Cecilia Skingsley, who since 2013 has been deputy governor of the Riksbank. She, as well, is a member of the Committee on the Global Financial System, but prior to joining the official central banking community, she was a chief economist at Swedbank, a large bank that we all know. Then on my right, immediately to my right, is Ravi Menon, who has been since 2011 the managing director of the Monetary Authority of Singapore. In addition, he also participates as a steering committee member of the Financial Stability Board, has served as chair of one of the standing committees. Now, previously to being the managing director of the Monetary Authority of Singapore, Ravi served as the permanent secretary at the Ministry of Trade and Industry in Singapore. And I will say a number of years before that was on the secretariat of the FSB's predecessor, the Financial Stability Forum. So he was what I think of as a Basel veteran, as am I. Finally, on my far left is Blythe Masters, who's the CEO of Digital Assets, which she joined in 2015 after a long and distinguished career at JP Morgan Chase. Digital Assets, for those of you that don't know, I'm sure most of you do, supplies digital ledger technology for financial service industry. I think of Blythe as being on the front lines of the innovations that we're seeing, and someone who is here to give us very much the view from that front line. So with that as a brief introduction, I will turn first to Claudia to give her remarks. Please.
Thank you very much, Stephen. I wasn't aware that there's general financial stability. Whenever I talk about financial stability, people say, well, this is so broad. What are you covering? But general, it makes it even broader. This is a fascinating topic, how do new technologies shape the future of central banking? And I think the interesting thing is that the intensity with which we discuss the topic doesn't really match the knowledge that we have about how these technologies are actually affecting financial services. So this will actually also be one of my conclusions, that we, if we want to draw policy implications from the developments we see, I think we also have to improve our knowledge about the sector, which does not necessarily mean we have to collect more official statistics. Maybe we can use big data sources, which are at the heart of many of these new technologies. We will see. But let me start a little bit with what we know and what we don't know. And in what I'm going to say from what you've heard before, I will focus on the financial stability aspects of fintech firms. So in terms of the size of the sector, it's actually interesting to see that that the Chinese market is the biggest one in terms of size, but even there, if you just look at credit intermediated, how is the acoustics? Because I hear kind of a doubling effect. Is that okay? Yeah. Okay. So in terms of size, the Chinese market is the biggest. But it has, even in China, the share of credit intermediated through fintech is only 0.6% of the market. So that tells us a bit how small the market still is, and it's very difficult to tell how things are going to be evolving. What we know in terms of, obviously, it's not only the size that we're interested in, but also the efficiency gains and what does fintech contribute to efficiency. I don't think there are many specific studies on fintech, but there's interesting work looking at, in general, how the cost of financial intermediation have been changing, and there hasn't been much change over the past decades, even though we had a lot of technological evolution over time. So I think this is also an interesting stylized fact that we have to be aware of. But again, I'm also in charge of statistics, not only general financial stability. If I go to my statisticians and ask them what do we know about the size of the market in Germany, they tell me we don't even have an agreed definition, we don't have any reporting standards, so this is certainly something we have to work on. Now, when I then turn to my financial stability division and ask, well, what are the effects of fintech on financial stability, they basically give me the whole laundry list of things how financial stability could be affected. So herding effects, procyclicality, cyber risks, but also improvements in efficiency, improved information processing. So it's basically all dimensions of financial stability could be affected. And again, we don't know yet how the system is evolving, how fintech is going to contribute to financial stability. So the point I would like to make here is that for me, the most important metric or field that we should be looking at is really the link between competition and financial stability. Because if you think about how fintech firms could affect financial stability and risk-taking, it's really through the competition channel. And it could be that more intense competition for the incumbents, for the traditional banks. It could be that this is actually leading to efficiency gains and all the positive benefits that we have, but it could also lead to increased risk-taking if margins are coming under pressure. We know from a lot of empirical studies that has a negative impact potentially on risk-taking. Of course, there's also a balancing effect. If we have more competition, lower margins, lower interest rates, it could be that the firms that are getting the loans are engaging in less risky activities. So that could be one channel, and the jury, I think, is still out whether increased competition through fintech firms has a positive or negative impact on these risk-taking effects. There's also, and I think others on the panel are much more experts on this, there's also, of course, the potential that fintech firms and financial innovation is affecting the network structure of markets, the procyclicality in the network. And again, these are things that you can relate to the competitive structure of markets. So having said this, I think one of the things that we need to do going forward is to really think about how financial stability and competition interact. Now, I'm not talking about broadening the mandates of central bank, because we have in the past years, we have already broadened our mandates when it comes to financial stability in addition to the other mandates that we have, but we do have competition authorities. They also think about the effects of new technologies on financial markets, and I think we need more of an interaction in our policy discussions with the competition authorities, because maybe we'll come back to the issue about sandboxes. So some of the central banks and the regulators are engaged in the promotion of fintech activity through sandboxes. So this can be a way to overcome barriers to entry. So it can be a positive effect, but it may also be the case that we are promoting certain technologies, setting certain standards, which can also have implications for the competitive structure of markets. And I think this is something that we can't deal with alone, but we need the interaction with the competition authorities. Maybe a bit more confined to our policies. Competition means, I mean, certainly it's something positive because it creates innovation. Jens Weidmann this morning talked about the Schumpeterian effects of having more innovation. But of course, the financial sector we know is a little bit different. I've alluded to some of the aspects already with regard to risk-taking. We also know that in the financial sector, in particular for the larger incumbents, we can't simply apply standard insolvency regulation like we're applying to non-bank firms. So I think we also have, when we discuss the impact of new technologies on the financial sector, we really have to think about what governs entry and exit into the sector, and how can we allow the sector to smoothly adjust to the new challenges through fintech activities. And finally, I haven't said anything specific about how should we regulate. This, of course, has to do with the fact that we know so little about these markets. But we really have to look at the fact whether new entrants create similar risks to banks. Then there might be a case for similar regulation, but the risks might also be very different, which may require different types of regulation, or no changes in the regulation at all, because regulation has to be technology neutral, but there's basically still this range of options. And I think before we think about very concrete regulatory responses, we have to learn more about the sector. And I think there are very good initiatives at the FSB and in other committees that have been mentioned that are trying to do a stock take also of the information that we have. I guess I'll stop here, and thank you very much.
Thank you.
So I would like to start that I agree with what our distinguished host, Dr. Jens Weidmann, said this morning when he mentioned that digitalization may cause some tectonic shifts also for central bankers. I'm going to take you in the next minutes to Sweden, where we're going cashless. It has not been a conscious decision by the Riksbank or by any other legislators that we are going cashless. But the combination of technological change, people behavior changing, and legislative circumstances is creating some rapid movements, and this is a head-scratching moment for a central banker such as myself. So first of all, the value of cash in circulation in Sweden is decreasing quite rapidly. If we look for now and go back 10 years' time, I would say that the value of notes and coins in circulation have been decreased by about 50%. And if we look at point of sale statistics, about 15% of transactions are now done with cash. The remaining 85% are done with debit card or something equivalent. And this is also a very rapid decrease compared to a few years ago. So why is this happening? Well, as I said, the combination of legal conditions and the rapid technological changes is pushing the evolution in Sweden, because it is an evolution rather than a conscious path. Looking at the supply side of the payment market, you can say that the infrastructure system in Sweden is the result of a cooperation between the banks that goes decades back. They were successful introducing cards in the 70s. They were very successful getting rid of checks in the 1980s. They were also very successful launching together an instant payment app 2012, which makes it possible for people to make instant payments 24/7 connected to people's mobile phones. So supply side, moving towards a cashless society has been very, very strong. And on the demand side, I would say that Swedes are in generally very happy to be early adopters to new technology. We had subsidized computers at home in the 90s. We love our telephones, mobile phones. You would love it there, Stephen, with your phone. We have a lot of funny gadgets you can use 24/7 if you wish. Early investment levels of broadbands to provide internet-based services has helped considerably. And you can also say, and this is perhaps more of a cliche, but you can say that the high level of trust among Scandinavians in general versus their authorities and versus companies in general, including banks actually, has helped facilitate the development. And more than 90% of the Swedes have access to debit cards, and if you ask them what sort of preferred way of payment method would you like to use, most of them say cards rather than cash. The Riksbank is also, you can say, guilty to the development. The Riksbank, my predecessors in the 1990s, decided that they would gradually withdraw from handling both the storages and the transports and logistics of cash, and pushed upon to the private sector to handle cash and see cash as one payment method of many. And then the true costs of handling cash as a payment method became apparent to the private sector. And from there on, you can see that the private sector, meaning the banks and the shops, has been continuously been trying to dismantle the service level of cash as a payment method, and they have also dismantled the cash providing network across the Swedish geography. I also said that the legal conditions here are important. It's not only technology, and people are being either forced or being preferred to change behavior. There are no legal requirements for shops or any other commercial entities in Sweden to accept cash as a payment method. Have you been to Stockholm or in Sweden, you may have come across little signs at the cashier saying cards only or our particular payment app only. And from a legislative point, that is acceptable in Swedish legislation. What is more strange, perhaps, is not even banks are under the legal obligation to handle cash. So we are in a situation where money, or at least central bank money, our version of money, notes and coins, will not be very functional as a way of payment in the 2 or 3 years from now, I would say, give or take a few years. Commercial entities will most likely stop accepting cash as a payment method. We, as a central bank, we are under the legal obligation to provide notes. But I have an example of our product with me here. But it will probably only be used, or more or less, majority will probably see this just as a store of value rather than a medium of exchange. Not very useful, at least for commercial medium of exchange. And then the questions open up. How useful will they actually be if they cannot be used on a broad scale as a medium of exchange? So the Riksbank is now faced with 3 options, basically. The first option is to do nothing, to see cash being phased out as a commercial medium of exchange. And cash will be offered from the central bank, but mainly just as a store of value for those few who still would like to use it. The second choice the Riksbank has is to try to preserve the usage of cash one way or the other. We could ask the parliament for making it compulsory for banks to handle cash, or we can even ask the parliament to make it compulsory for shops to accept cash. But there is so far, and I don't think there will be, a strong majority or any kind of majority politically to conserve or preserve the cash usage in Swedish society in that way. We may also only slow down the evolution, but not really change the trend. And the third choice for the Riksbank, and this is something that I'm going to just broadly introduce you to, is to look into a more modern version of central bank money, a digital issued central bank money, what we have called, or I have sort of christened the product, should the Riksbank issue an e-krona. And this would be a central bank digital currency, same exchange or same value as the notes and coins, but accessible through the digital means instead. And this opens up a great variety of really, really interesting but equally difficult questions, which really strike to the bone of what central bank is all about and what sort of offer we want to give to the society. Should the scope be small scale or large scale? Should we have it token-based, very simple prepaid cards, that sort of technology, or should it be large scale, more register-based currency? Should there be account-based or not? Should it be accounts in the central bank, or should we push it to the banks to keep the central bank's accounts or not? Should it have interest rate on the central bank digital currency, or should it be interest rate free in the same way as notes and coins are interest rate free? We are looking into the technology issues, and in the same way as we would never considering issuing a note that is easy to counterfeit, we would also not consider issuing an e-krona that is easy to counterfeit, since confidence in central bank is very central to us all. The integrity issue is also very critical. I would say most Swedes seem to be happy to give away the integrity, since they are very happy using the commercial payment methods, but that may change, and then the question is, what sort of integrity should this e-krona provide versus the needs to adhere to anti-money laundering and anti-terrorist financing legislation scopes. We also have various consequences during launch of a central bank digital currency, how it will work in a steady state. But for financial stability purposes, what would happen in a financial turmoil if you have a straight access from commercial bank money into central bank accounts? So as you understand, we are quite busy up in Stockholm looking into these things, and we have allowed ourselves 2 years, which is a very short time, just to take a first step on analyzing the needs, the potential design, and what we see as the potential consequences of a digital currency. We haven't made a decision whether we're going to launch something or not. But no matter the preferences, what we may express later on, we have to do the homework. We don't see complacency and being on the sideline as society moves forward and people change preferences is an option, because for us the future, the technological future, has already happened in Sweden. Thank you.
Thank you. Ravi, please.
Thank you, Stephen. Let me begin by thanking the Bundesbank for inviting me to this momentous occasion of its 60th anniversary, and I join others in wishing the Bundesbank happy birthday. I think over the decades, the Bundesbank has stood as a paragon of central banking, much admired over the world, disciplined and focused on its core mission, price stability. Now it's part of the Euro system. The Bundesbank continues to be a beacon of thought leadership on macroeconomic issues, and an ardent advocate for monetary prudence. And I think the elegant simplicity of how the tagline for the 60 years, committed to a stable currency, I think says it all about the Bundesbank. So once again, congratulations and happy birthday. This panel is focused on how technology could shape the future of central banking. And there's a wide range of different technologies already beginning to transform different aspects of financial services. You have digital payments. Cecilia spoke about it becoming more widespread, propelled by advances in near-field communications, in biometrics, and identity authentication. You have internet-enabled distribution platforms for making financial products now directly available to consumers. You have peer-to-peer lending, robo-advisory services, Stephen talked about it. Pay-as-you-use insurance models are emerging now. Big data, where you aggregate large data sets from multiple sources, use natural language processing to make sense of qualitative, unstructured data, using smart sensors to gather additional insights, and bringing all that together. This is already having applications, pilot applications in many areas of finance. So there's a broad range of different technologies going on. In fact, I think it's not possible to talk meaningfully about technology or fintech without being specific about the technology and its particular application. The issues vary widely across different technologies and applications. So what I'll do is I'll just pick 2 possible scenarios for the future where technology dramatically changes the banking landscape. First, fintech firms disintermediate banking services. Second, central banks start issuing digital currencies in a big way. Both quite extreme scenarios. I'm not making a forecast, but not entirely implausible. And some of this is already happening. So, and while at it, I'll also take a reckless plunge and share some thoughts on what these scenarios might mean for monetary and financial stability. First, fintech disintermediation. Traditionally, commercial banks have acted as intermediaries between central banks and the public. They distribute cash, they facilitate fund transfers, and they are the primary issuers of payment instruments, such as checks and cards. More recently, this role has come under threat from fintech players who have the ability to come between the banks and the final consumer by providing banking services in a user-friendly, customer-centric package. As they say, people need banking. They don't need banks. In fact, more than a decade before fintech became a noun, PayPal was already helping people around the world buy and sell on eBay. To buy something from a total stranger on the other side of the world. All a buyer had to do was to key in his credit card details, and PayPal took care of the rest. No SWIFT codes, no expensive fund transfers, telegraphic transfers, or uncertainty about how long it was going to take for funds to be available to the seller. So in the age before fintech, PayPal was already using technology to mitigate counterparty risk in a user-friendly and streamlined package. And in doing so, it disintermediated one aspect of banking functions. And this was the transactional business of banks depended on this, on their role as gatekeepers of the financial system, that you interact with the financial system through the banks. That is changing. And the most striking development that's driving this change is APIs, application programming interfaces. 2 years ago, I didn't know what it meant. Today, I live and breathe that word because I think it is going to fundamentally transform banking. If APIs, or application programming interfaces, these are the corridors which allow fintech players or any other person to have access to services. These are the protocols in which two systems talk to each other. And when these protocols are established, systems outside the banking industry can talk to banking system protocols and extract insights, data, solutions that can be packaged for consumers. This is a big, big thing. And it's allowing fintech players to have a direct interface with the banks and to provide their consumers with seamless access to banking services. What does this mean for monetary and financial stability? Now, in an environment where non-bank fintech players can seamlessly offer services to consumers, banks may increasingly be relegated to the role of a utility provider, holding customer deposits and managing the associated risks. In that scenario, banks would still play a critical role in facilitating access to money, in the same way that a power company, for instance, plays a critical role in facilitating the delivery of electricity to our homes. And to extend the analogy, what do the fintech solutions do? They plug into banks' APIs. That would be akin to the appliances that we plug into wall sockets and tap on that electricity. They are still regulated for safety and compatibility, but not so much for systemic impact at the national level. And we may have to accept that there will be both high-quality appliances and low-quality appliances that plug into banks to offer solutions. And we probably will allow fintech companies, depending on our risk appetite, they're akin to appliance manufacturers, to innovate and be disciplined about the particular risks that each of these solutions or players pose to the system, so that we right-size regulation to address the risks they pose. So the question is not whether to regulate them or not, but to regulate them for what purpose. And just as it does not make sense to subject a light bulb to the same regulatory framework as a power plant or a washing machine, so likewise, we should not subject a simple payments company or a bank balance aggregator to the same standards of a full bank. But we do need to understand what are the risks that a payment service provider poses and what are the risks that a bank balance aggregator poses, and right-size regulation. There's a lot of catching up and adaptation that's necessary. In the future I described, I believe that disruption and competition will vastly expand the variety of solutions. And this is not to say that risks will disappear, but we need to know where the risks are residing. Second example or scenario I want to talk about is central bank digital currencies. Story begins with cryptocurrencies or bitcoins. I think many reasons why privately issued cryptocurrencies will not replace central bank issued money anytime soon. I agree with Jens Weidmann's comments this morning on this. Bitcoin is still valued in US dollars. Demonstrates that cryptocurrencies derive their value from traditional money. There are concerns about price stability. How can a currency that gains over 370% over 6 months be a stable store of wealth or means of exchange? And then there are the risks associated with money laundering, terrorist financing. These are non-trivial obstacles to their widespread adoption. It's not to rule them out, but I think there are lots of issues that need to be sorted out. But the technology that underlies cryptocurrencies, the blockchain or distributed ledger technology, DLT for short, I think will have a significant potential impact on banking and by extension, central banking. Blockchain is already being tested for a variety of financial operations. They're being used to reconcile trade finance transactions. They're being used to execute performance contracts and so on. But I think it's in the core plumbing of the banking industry, or the banking system, namely payments, clearing, and settlement. This is where DLT could well have its biggest impact. We cannot predict the exact role, but we need to explore its possible implications. And what better way to explore than to experiment? So at the MAS, we believe that DLT has a potential, not necessarily as a competitor to traditional central bank issued banknotes and reserves, but perhaps as a facilitator for faster and more secure clearing and settlement. So we set out to experiment with DLT as a complement to our own real-time gross settlement system. So last year we embarked on a collaborative project with the Singapore Exchange and 8 other banks to explore the use of DLT for interbank clearing and settlement of payments and securities. The goal is to reduce risks and cost for settlement and payments. We've just completed the first phase of the project, rather modest, which focused on just the interbank payments of Singapore dollars through DLT. So that demonstrated that it was possible to do it by exchanging a tokenized form of the Singapore dollar on a distributed ledger. And we call this central bank digital currency. And each token is fully backed by an equivalent amount of Singapore dollars, so there's no change in the overall money supply. Banks deposit cash as collateral with the MAS, the central bank, in exchange for central bank digital currency. The banks can later redeem these central bank digital currencies for cash. But what it allows them to do is that they can use the central bank digital currencies to pay each other directly, instead of first sending the payment instructions through the real-time gross settlement system residing at the MAS. So it takes the central bank out of that equation. And so the experiment showed that it works for interbank payments. Heartening result, but this is just the beginning. Because you already have real-time gross settlement systems. The increased efficiency coming from the DLT application to this is not very large. It's not a compelling benefit. So in the second phase, we want to broaden the scope to evaluate the use of DLT for the settlement of securities, where I think there are more challenges, more frictions, more inefficiencies, and potentially cross-border payments applications, where the current banking system is grotesquely inefficient and costly when it comes to making a cross-border payment in 2 different currencies. And by the way, the experiment is limited to wholesale payments. We don't envision digital currencies to be made available to the general public in the foreseeable future, because as Cecilia said, there are many interesting questions that arise in that kind of hypothetical scenario. And let me just take a stab at some of these implications. On the positive side, broadened access of non-bank general public to the central bank's balance sheet through central bank digital currencies could enhance the transmission of the monetary policy mechanism. The accounts held by non-bank participants could be directly remunerated at the policy rate or even at a negative rate. By expanding the number and speed of transactions, channels, digital currencies could increase effectiveness of monetary policy. And the central bank would have real-time information on all transactions in the economy. There are also lots of risks with making this widely available. First, it introduces an element of unpredictability into monetary policy. To the extent that the monetary policy transmission mechanism is affected through the use of these central bank digital currencies, and the relationship between the monetary policy instrument, the interest rate, money supply, or the exchange rate, and the policy targets of inflation and growth would change, and the effects of monetary policy actions may become more difficult to assess. Second risk, making available central bank digital deposits to non-banks and the general public could disintermediate bank deposits and undermine banks' ability to generate credit. Households and corporates could maintain digital accounts directly at the central bank for payments purposes or as a store of value, savings. And if deposits shift in a big way to the central bank, banks might have difficulty funding their lending activities. Now, in peacetime, there is no reason to believe this will happen in a big way, especially if the central bank pays little or no interest. Banks would still compete for deposits through high interest rates or better service. But things could be very different in a systemic banking crisis where confidence in the financial sector is shaken. There's a possibility that bank runs could occur more easily and progress faster as depositors view the central bank's digital currency as a safe asset class and shift funds out from banks into the central bank. So there's a lot we still don't know. Much we do not know of the benefits and risks arising from technology for monetary and financial stability. But one thing is clear, we can't stand in the way of technology and change, especially when many of these technologies hold so much promise for enhancing efficiency, reducing costs, and improving people's lives. So as we look to the future of central banking in a technology-driven world, let's continue to anticipate the kinds of changes that are coming, work to enhance and harness their benefits, anticipate and manage their risks. Actually, it's not very unlike what we've been doing for the last 200 years of central banking. Thank you.
Thank you, and I'd like to add my congratulations to those of others for a very happy birthday to this venerable organization. I must admit I was struck at dinner last night that there aren't very many organizations in the world that have the combined humility and intellectual prowess to recognize that there are things that central bankers can learn from the behavioral biases of monkeys and discuss that at length over dinner. It was a great, for those of you that missed it, ask afterwards because it was a great analysis. Going last has its challenges and opportunities. The opportunity, of course, is to have the last word. The challenge is not to repeat that which has been said before. So I shall try to fill in around the edges of the excellent comments that have already been made by my central banking colleagues. And I'm the least central bank-like of the panel. I'm not sure whether that means I have to be more careful or more free-flowing. On my way here, was copied on a tweet that came from a luminary in the blockchain world who can remain nameless because it's illustrative of a school of thought and may in fact have been taken out of context. And the tweet, with great enthusiasm, many exclamation points, referred to a quote that said, "The tyranny of the unelected state is bureaucrats not only writing their own laws, but also interpreting those laws." Now, no offense to the central bankers and supervisory authorities in the room, but you were certainly in scope in the criticism of that comment. And what that really reflects is a perspective from some of the early advocates of what has now loosely become known as the Fintech community, and in particular the blockchain world, is a perspective that the world would be better off if all of us were able to directly interact in terms of our financial activities without the need for intermediaries or adult supervision. And intermediaries into that category falls banks generally, including central banks, adult supervision, regulators, and banks. And so when I was asked today to provide the perspective of fintech to the central banking world, and I also am known for running a distributed ledger technology provider and a blockchain company, if you will, I had a sinking suspicion that I might be going to be asked to defend that point of view and articulate a view that these technology developments are going to result in the rendering redundant or elimination of central banking and other financial intermediary functions that this audience certainly has become accustomed to and believes in. That is not, however, the perspective that I will offer to you today. I think that it is naive to believe that some of the original motivations behind the invention of some of the most disruptive or potentially disruptive technologies will necessarily prevail in the longer run. And already we have seen, and indeed you heard Ravi outline, the fact that existing incumbents, central banks included, have become extremely aware of the potential benefits that new technologies provide, not only to consumers of financial services, but to those tasked with supervising the overall stability and safety of the financial system. So we often hear, in particular, when talking about the benefits of blockchain or DLT-inspired technologies, that there are enormous benefits. And those benefits include the opportunities for greater transparency. So, for example, the opportunity to have a central bank be able directly to observe activity rather than to have to issue through its supervisory authorities subpoenas to 15 different broker-dealers in order to get the picture of the activity of one ultimate beneficial owner of a financial instrument, for example. So greater transparency, lower cost. What essentially is distributed ledger technology? Well, after you cut through all the hype and the hysteria, I'm afraid it's not a lot more than a very powerful and very new and innovative form of database technology, a new form of database architecture, in fact. Once you realize that that's what it's all about, it becomes a lot less exciting and actually much easier to absorb. Really what the innovation is here is the introduction of a form of database architecture that instead of encouraging different participants in this financial system to separately hold, record, and manage their own records of important financial data as financial processing occurs. Instead, you have the opportunity to mutualize and share a common or golden record of that information. Now, in theory, you can see why that has obvious benefits. For example, the opportunity to eliminate entirely the zero value added function of ticking and tying different records of what should essentially be the same piece of information by a process of reconciliation. This is a process that tens of billions of dollars are spent on a year and ultimately directly comes out of the pockets of those who save, who invest in financial instruments and otherwise look to earn a return on those savings. Now, why do we all tick and tie? To make sure that we're in sync, because we keep separate records of the same information, and we have fiduciary responsibility to ensure those are correct. But if you had a way to share that information whilst preserving privacy and confidentiality, not sharing the content, but being able to validate its integrity, then you have the chance to mutualize. And the chance to mutualize this information is an enormous saving to cost, to speed and time with which it takes to execute, and by extension to risk. Because as you know, delays in the completion of any financial contract result in risk in the financial system. So you will hear many advocate for these benefits. The question is, at what cost? Or perhaps more specifically, with what risk consequences does this technology take hold? And I'm going to point out that in everything I'm about to say, I am not assuming that the central banks of the world, for whatever motivation, digitize their fiat currencies and issue them in original digital form. As we already know, a high percentage of payment activities are conducted electronically. That's not the same thing necessarily as having digital issuance. You heard in Sweden we're already at 90% non-cash flows, so that means 90% electronic activity in some way, shape, or form. So I'm not assuming that central banks of the world issue and digitize their fiat currency. That would be an additional potential enhancement to efficiency. It has also monetary and other policy implications, which Ravi has just outlined, I think, very comprehensively. So just assume that we stick with today's real-time gross settlement payment systems around the world, which, by the way, function at relatively high speed, at relatively low cost, particularly as it relates to wholesale financial payments and settlement purposes. Rather, think about the application of distributed ledger technology to things like clearing and settlement, as Ravi said. If you can do this, the benefits are enormous. Increase speed, reduce cost, reduce risk, reduce capital. But what should central banks and regulators worry about if this technology is to be deployed for this purpose? Well, it's not a short list. You need to be concerned that no one forgets about the importance of KYC and anti-money laundering regulations, and nobody uses the technology to bypass that. You need to be concerned that the privacy and confidentiality of financial transactions is maintained under all scenarios, including the as yet not real, but in the future quite possibility that something like quantum computing evolves to the point that it is able to defeat encryption algorithms. Imagine what that would mean in terms of suddenly displaying shared information that was protected via encryption to anybody and everybody. It would have enormous implications to financial stability, creating instability. What about consumer protection and making sure that nobody that is unqualified or unprotected gets access to activity they should not otherwise have in the financial world? I think there are some very real questions to be asked about the current rash of initial coin offerings, which could be argued to be a form of securities offering that is being undertaken all over the world to the tune of billions of dollars of value without direct supervision or regulatory intervention. What about resiliency and systemic risk? Are these new technologies stable? And are they going to hold up in the face of the kind of transaction throughput that you need to run a national market infrastructure, as opposed to a small sideline financial activity that perhaps a smaller fintech could undertake? What about uncontrollable smart contracts, where we've encoded financial contracts but forgotten to include the break glass or stopgap measures that are needed when something goes wrong? Anybody that's worked in technology for any length of time will realize that the introduction of bugs to computer code is just a greater risk as any other form of risk of mistake in the financial system today. So the list goes on, and the question is, how should central banks and other supervisory authorities respond to the combination of rapid technological innovation and the enormous benefits that are in play here? You've already heard stories about the engagement of central banks and others from an educational point of view, from the point of view of conducting experimentation, from encouraging their banks and other constituents to collaborate and to demonstrate efficacy. And this is something that I would strongly advocate for the encouragement of. I also would point out that by and large, and as a vendor of technology systems that are targeted precisely at systemically consequential market infrastructures, by and large, existing regulatory authority grants enormous control to central banks and supervisory authorities when it comes to ensuring standards of stability and safety in systemically consequential market activity. In other words, you cannot wake up one morning and become the central clearing agency of Singapore, nor indeed Australia or anywhere else in the world, without passing a raft of tests that address stability, access, reversibility, auditability, capacity, compliance with the law, the absence of introduction of unnecessary credit risk, so on and so forth, the monitoring of operational risk. So those principles, many of which incidentally are enshrined in the IOSCO principles for market infrastructure, operation of market infrastructures, give a roadmap that already exists that I think provides fantastic guidance for those seeking to think about the consequences of widespread adoption of this technology in terms of the questions that need to be asked of technology vendors and their customers who are responsible for operating such infrastructures. We are working on a project in Australia which has the benefit of being a relatively concentrated market structure. So a single entity responsible for all of clearing, settlement, and the update of the central securities depository. So this is a national scale. It's the top 10 global stock market. There are implications if this were to break or to leak or to become no longer confidential and so on. And that project is in its 18 months or so since inception. And are having to answer questions about all of the list of issues and concerns that I outlined for you. And I can assure you that if the answer to any of those questions is unsatisfactory, that project will not continue to fruition. I can also assure you that after having invested 18 months, not only of my company's time, but more importantly, our customer investing money and time for that length of time, at this stage, they're very confident that they have good answers to those questions. The irony is that if you look at the original public Bitcoin blockchain, which was invented for a very specific purpose, the ability to facilitate anonymous transfers of value over the internet between entities that don't know each other and have no recourse to a rule of law in the event that something goes wrong, that's a very different requirement than the one where you're operating a national market infrastructure subject to a known rule of law and subject to market regulation. And if you switch that context and change the devil in the details of how you deploy and configure the technology, a lot of the things that you instinctively know couldn't work in the public blockchain, Bitcoin blockchain world actually can work in the context of deployment of similar but differently configured technology for this different context. So where privacy counts, where no anonymity is permitted, where any entity involved is pre-credentialized and identified in advance, where the rule of law is enshrined rather than bypassed in the way that the technology interprets the contracts that are denominated in code rather than written any longer, and where there are the necessary break glass or stop gaps that enable this technology to be used to achieve the efficiencies without the loss of control and security. So my expectation is that you will see technologies of this nature begin to proliferate. It's going to take many years. It's a multi-year, if not multi-decade process. But there are choices within the devil in the details that will yield enormous benefits both to market participants and to those tasked with supervising and ensuring the systemic stability of those markets. Thank you.
Thank you very much. Well, those were terrific and very comprehensive interventions. It's difficult for me to sit as the moderator and think of questions that weren't already addressed, but I'll give it a go in any case. And let me ask, I think generally, what I've heard and what I've seen is something about, these are technologies that are very different in a lot of cases from things that we have encountered before. They're providing services in very different ways. And they're also, the innovations are occurring very, very quickly. So if I look at the regulatory system that has been in place for quite a long time, what I see is something that is, first of all, very time-consuming, and secondly, tends to be a bit reactive, if I might put it that way. So what I'm wondering is, it's a little bit like when Jaime Caruana said that we had to change our time frame and our view of how it is that we analyze the economy in order to understand financial risks as different from business cycle risks. I'm wondering whether we have to speed up in this case, and if so, how is it that we should be thinking about the regulatory framework, both from the side of the people who are on the side of the regulators and from the side of the people who are being regulated? I don't know if you have comments or reactions to what others said.
I'm trying to think about this speed up. Should we speed up with our regulation? Right. I'm not sure what that means in terms of, does it mean speeding up in designing new regulations for new institutions? I would be very careful with that part because, as I said before, for me, the purpose of regulation is to, first of all, I mean, technically speaking, internalize externalities or make sure that we don't have excessive risk-taking and all these things. And I think when we talk about these new technologies, we still have to learn a lot. So speeding up, I would say, in terms of learning more about the segment and making sure, you said that DIT is database technology, and that's not exciting. I think that's extremely exciting because it may actually, maybe it also helps us in our learning about, you know, how the system is evolving and how the competitive nature of the market is evolving. And from that, I would draw conclusions about regulation. It may be that our existing regulatory framework actually fits because we are regulating the banks to the extent that the banks are using those new technologies. Maybe we don't need additional regulation or new regulation. It may be very different. It may be that we have new actors arising and which require different regulations. So the speeding up with regard to learning more, but then also stepping back and taking thinking about what we have seen and then deciding what we need to do. Maybe one more, remark on this. Also, somebody said on the panel, maybe we don't need intermediaries anymore, so maybe we have to rewrite our theories of why banks exist and our thinking about what they contribute to the real economy, because that's in the end what we are interested in. I don't think that's the case. So we had this discussion actually before. There was a very influential paper about are banks dead or are the reports exaggerated? Maybe we're a bit in the situation where we're exaggerating the trends for the future. So for me, the bottom line would be, to what extent do these new technologies help us overcoming frictions on financial markets? Because banks are there, because we have information frictions, there's a reason why we have these intermediaries, and that would be the true testing case. Are these things changing, which may have a lot of implications also for financial stability and other areas we're interested in?
Can I also take up this issue on speeding up things, because the world is speeding up? I would say when it comes to intelligence and surveillance, yes, we need to have a stronger ambitions there from the central bank world. But when it comes to regulations, I would say no. Intelligence and surveillance is important to speed up the ambitions. I mean, if you look back at the subprime development, if we all had been a bit more speeded up there, we may have been able to limit the damage to some extent if we had the regulations in place. But central banks and financial stability is about keeping systems resilient and protect consumers. And as new technology being put in place and there are hypes around it, from time to time, it's going to be failures, but you have to keep the protection in order and the systems in order. And there, I think it's important not to jump too quickly into new regulations.
Ravi, do you have a reaction?
So how should regulation respond to these things? I'll go back to what I started with. It depends on the particular technology and it depends on the particular application. And there's no single answer to. So let me give 4 scenarios. Payments. I think regulation needs to catch up because payments innovations have moved so far ahead. We're now at a point where we need to look at what kinds of safeguards we need to put in place, how to right-size regulations, because some of the regulations we have are overly onerous if they want to get a license, and in other cases, we make no requirements of them. So interoperability, cybersecurity requirements, two-factor authentication. I think these are some of the basics for many of the internet-based payment solutions that are proliferating. The second category of areas, you need to tweak existing regulations. Much of the existing regulation actually can apply. They're meant to be technology neutral, but not entirely, because the technology itself poses some peculiar risks that you must recognize. Robo-advisors is a very good example. Pretty much the expectations we place on financial advisors are placed on robo-advisors. In some regard, because these people aggregate at the back end the investment decisions, that it looks like a collective investment scheme, so we said, but this is incidental to your operation, we can ease that requirement. But we place an additional requirement that the boards and senior management running these robo-advisory services need to understand the technology risks, need to understand how the algorithms work, and what measures are being put in place in their firms to address bugs, possible bugs in these algorithms. That is a risk that doesn't apply to a face-to-face kind of advisory situation. So in some sense, you have to modify to take account of that particular technology. The third category, I think things like cognitive computing, machine learning, distributed ledgers technology. I think I would say don't preempt innovation, stay on the sidelines, watch, participate, experiment, go into regulatory sandboxes, but we just don't know how this is going to evolve, and it's, I think, premature to try to put in place standards or protocols or regulations.
Let me ask Blythe, do you think that we need a better dialogue as a consequence of this between the official sector and the private sector?
Oh, I would say actually that the quality of dialogue is pretty good. The MS is just one example, but many of the central banks and supervisory authorities around the world are engaged in a very active dialogue with an array of fintech providers and users within the incumbent community of fintech services. By the way, I agree that the word fintech is a sort of a gross generalization, and the notion that financial services didn't have anything to do with technology until pretty recently is also somewhat laughable, as we discussed earlier. But I would say maybe 2 years ago, things were a little behind the curve, but certainly in the last 2 years, the level of engagement has shot up and is appropriate, I think, to the issues in hand. And I totally agree with Ravi's comments that the proper answer to that question is it depends, because there's an enormous array of activities here that need to be thought about. And there are areas where there's plenty of pre-existing regulatory framework, and other areas where it's obvious that certain activities are presumed only to be done by banks. And when they're not done by banks, for example, then you have to ask yourself other questions.
Thanks. I mean, I think related to this is the question of whether or not the regulatory framework, and I think this is for my official sector friends, whether the regulatory framework does need to adapt, maybe not speed up, but adapt to take into account the fact that functions of banks are being now performed outside of the banking system. So do we have in some jurisdictions, I think this is more difficult, do you feel a sufficient structure for how to actually deliver systemic risk reduction and resilience through that framework as things escape from the banks? I mean, I think maybe in Singapore, probably you have the strongest of these.
I'm not sure about that. As I said, With disintermediation of many banking services by fintech firms, enabled by application programming interfaces and the like, it's today still early days. We can't quite tell where the risks are. In a good outcome, I'd say because banks are the ones still holding and taking deposits, and that's where the bulk of the risks are managed, then the risks are then best supervised and regulated in that place. And you hope that that's where the risks are concentrated, in well-regulated banks. The bad outcome is you're not quite sure where the risks have gone to. Subprime is an example in a non-technology kind of sense, where financial innovation spread risks in ways that ought to have distributed the risks, but unfortunately it was being held by entities that were least able to hold those risks, and there was great opacity as to where the risks are. With fintech disintermediation, could you have a scenario where risks are similarly distributed, but because they're opaque, you do not know if they are concentrating in some areas with potential harmful effects on parts of the economy or financial system? You just don't know. So I posit both a good outcome and a bad outcome, which is why regulators need to watch very closely about where the risks are migrating to and react accordingly. So short answer, I actually don't know.
Well, I think this brings us to Claudia, to your point about data, maybe. I don't know if you, but go ahead and, well, you had a different point to make, I'm sorry.
Well, maybe it's a bit related also to this, why do we regulate banks? If we really go back to the beginning, I mean, it's really about the combination of deposit taking and lending activities. That's a key reason why we regulate banks, because deposits are typically short-term and the loans are long-term, so there's a liquidity, the run risk, and this is why we say we need and then we have deposit insurance, and that's why we need bank capital regulation. Now, if we think about slicing up the value chain, and if we don't have these two services being offered in the same institution, it may be that the risks are very, very different. And this is what Ravi was also saying. It's not clear whether the same type of risk is migrating somewhere else, or we're creating different risks. It might actually be that the risks are also reduced, but we really have to understand what these potentially new institutions are doing, and whether we have bank-like risks that then should be regulated like banks, but just that you offer a service that a bank can offer as well doesn't mean you have to be regulated in the same way. There's a specific reason why we regulate banks in a specific way. In the end, it all comes to data and knowing what they actually do.
Looking at payments, the question is, are we sort of satisfied with the regulatory scope when things migrate outside the banking system? Yeah, I can see a kind of a gloomy future where sort of banks are sort of taking over more and more of the high-powered money-making payment infrastructure. And then in Europe, we have the PSD2 directive coming in. You can see the potential for a fragmenting of this new sort of more privately run private market. And then we'll end up in a situation where you have Amazon money, we have Hilton Hotel money, we have Starbucks money. And then we're sort of back to a very old debate again, sort of 19th century debate when different banks issued notes. And it became very impractical. You had to have various tables with exchange rates between different private banks. So the idea to actually found central banks was about standardizing a unit of account and also nationalize the seigniorage. That was some of the purposes of issuing or starting central banks, but was mainly standardizing payments. And we may end up in a situation where we have to think about these things again. And preferably, central banks has to be a little bit ahead of the curve there, rather than ending up in a very fragmented money creation situation. That would the society would not cherish us if we do sleep on the helm there.
Any comments? We have a few minutes, and why don't we see if there are some questions in the audience. Whoops, I can't see. Oh, there, right in the back. Thank you very much.
Thank you. Dirk Niepelt, Study Center, Gertz and Sey, Swiss National Bank and University of Bern. So the panel has touched a couple of times on the question of central bank issued digital currency and also raised some of the positive issues related to that. I'd like to shift the focus to the normative question. It seems very likely that central bank issued digital currency would crowd out private money, at least to some extent. And I'd be interested to hear your views on what the social costs and benefits of that are going to be. Are there large social benefits of private money creation that we would lose in the process?
So can I start on
Please.
that one? Well, I think the short answer is it depends on how you design the offer of central bank digital currency. If you just assume that you do it fairly unattractive in the sense that you can only have an account at the central bank, but you cannot very easily move with that kind of central bank money in and out of the banking system and use it as a medium of exchange, then it won't be very, I don't see a great risk, but I see that there will still be a more modern exit for people who wouldn't like to stay and be dependent on the commercial bank system. Another way to do it sort of less attractive, but still an option for those who like to have access to central bank digital currency, is just to have a card with a limited amount possible to charge on the card for those who like to do their daily transactions in a money that isn't central bank money. So, but if you go all in, then that would potentially revolutionize how universal banks or the business models, what they look like today. They would probably have to pay up a lot more than they do presently to attract deposits. They may lose the deposit base more or less altogether. And then we will get very different kinds of banks. We will not have the maturity transformation in the banks. We will not have the mismatch in the banks. We will have a different financial sector than we have been used to.
Blythe, please.
I think this is a topic which is often conflated. There are a number of different strands of argumentation here. If you think about cryptocurrencies, which were the invention that led to much of the later debate around digitization of fiat currency by central banks, cryptocurrencies were invented for a variety of reasons, but one of them relates to efficiency of transfer over the internet, for example. Another of them relates to a desire for there to be a store of value and a means of exchange that is immune from intervention by central banks. In other words, a money supply that cannot be, quote unquote, manipulated by those responsible for managing the money supply. This is, of course, one reason why central banks generally aren't in love with the notion of their fiat currencies being displaced by cryptocurrencies. Now, which I would happen to agree wouldn't be a great thing for the world. But very often those same advocates for the case in favor of cryptocurrencies have inextricably linked the technology that fuels them to that case. And then when we talk about central banks issuing digitized fiat currency, it's sort of presumed that the same libertarian approach to the digitization would be taken. The fact of the matter is that distributed ledger technology is only one way that you can change the way in which the central bank provides access to fiat currency. And just for the record, as I think probably most of you know, as recently as 2008, there were still individuals who had accounts with the Bank of England, for example. You can guess why the Bank of England suddenly remembered that in 2008, because those balances expanded somewhat. Somewhat to everybody's surprise. Oh yes, we still have those. But the point is that if you digitize your currency, you do not have to change your monetary policy. You do not have to change the access to fiat currency. You can choose to do that, and you need, obviously, to analyze the implications, because as several of the speakers have pointed out, the implications, including the one that you mentioned, can be quite profound. But this one is a technology capability, and the other is a monetary policy decision and some other economic policy consequences. And one should not allow those to be conflated into one argument, especially by those who actually have an agenda in favor of a generally more libertarian, peer-to-peer financial system. We have to be disciplined in breaking the argument down.
Claudia, please.
Yeah, I think I would share with the concern that came through in your question about are we crowding out private money? Are we crowding out banks? And actually, I think we always have to start from what's the problem we have to solve. And I think what Cecilia told us about in Sweden is a very different situation than the situation we have in Germany. We have a fairly stable demand for cash for various reasons, and we've heard some other issues about cross-border payments. This is not a German issue, but in some other countries, and it's not really clear to me why these problems that we see in some countries, not in others, would need a solution in terms of digital currency of central banks, in particular being aware of the fact that we have very confined mandates, and we have price stability has been mentioned, we have some other new mandates, but I don't see that we should be in the business of providing services to private customers. And but again, I can't say anything about Sweden because you have a peculiar problem. I was actually, maybe just a little anecdote. The first time I was in Sweden, I was very proud. I got cash out of an ATM. Wanted to go to a coffee shop and buy a cup of coffee, and they told me, no, we don't accept your cash. So might be a very different situation from the situation we are facing here. But I don't really see, in that sense, I don't see the problem we have to solve, and we have to be confined within our mandate.
Another question over in the corner there.
Peter Luikmann from Eesti Pank, Bank of Estonia. I have a simple question for you. If you would need now to say or predict the future trends, there are two options basically regarding digital currency, central bank currency. More anonymous, token-based way, which basically means that we leave all kinds of hunting criminals to police, but just praise the anonymity, go the blockchain way, Bitcoin way, or another one which is a centralized central bank currency, which means that basically we ensure compliance, we do everything regarding the transactions, and we create a system where everything is verifiable, and later on there is no anonymity. So which way should you take, and if possible, no two-handed answers? Thank you.
Well, it's only 2017, and we have the option to investigate a bit further, but we can't do it forever. And a little bit of friendly, cautious advice. We didn't expect this kind of very rapid change in behavior in Sweden to happen. It has taken us all by surprise, but when people change behavior and the technology is there to facilitate it, you can get surprised. So don't be too complacent about it. That's my friendly advice. We need to look into this much longer. But if I should say anything, if I hold this gun to my head, I would say start small scale rather than big scale, because it's better to adjust things along the way rather than build something big and that goes wrong eventually.
Other comments?
I would say a couple of things. First of all, for what it's worth, I think that even cryptocurrencies designed to promote anonymity or pseudo-anonymity are significantly easier to trace than cash. And that has been proven to the chagrin of certain individuals around the world who've paid the hard way from not realizing that already. So law enforcement agencies around the world are learning a lot about traceability of cryptocurrencies as we speak. Second of all, I think that to the extent that cryptocurrencies, not centrally visible, traceable, etc., became pervasive in a developed economy with a well-established rule of law, something would be done about it to the extent that it was facilitating avoidance of money laundering restrictions or facilitating criminal activity or resulting in loss of central bank control over the money supply. And the law would change to prevent that. So if you're asking for a prediction, my prediction is that both will exist because they both serve useful purposes. The extremist one way or the other view, I wouldn't vote against a coexistence, but I would not expect world domination by cryptocurrencies that facilitate anonymous interactions of value. I think that's it's very naive. It would be a very bad thing, and I think the law is in the hands of the people who would dislike that happening, and they have the authority to prevent it.
There was one more question over here. Thanks.
Hi, Marco Del Negro. My question is the following, especially for the central bankers. If digital currency, do you envision digital currency as paying or not paying interest? And in the former case, that means foregone signorage, which particularly for a central bank like the ECB that does not have direct government support, may be quite important. What is your view on that?
For us, it remains to be seen. Haven't made any firm statement on that.
Comment, Ravi? Would you pay interest on digital currency?
Well, I think I'll go back to why we want to issue digital currencies in the first place. And as I said earlier on, and I think Blythe echoed that, there are huge efficiency gains to be had from reducing the frictions in our payment, clearing, and settlement process. So the use of digital currencies issued by the central bank that stays within the banking system to remove those frictions through distributed ledger technology, I think makes abundant sense. And you could actually extract most of those gains. I would also venture that it might be useful to apply that to cross-border payments, right? And there'll be huge efficiency gains. But I'm not sure whether there'll be new risks arising because now you have two central banks on either side of the of a cross-border interbank transaction. In my view, the Rubicon line is whether you make that available to the non-bank public. Because once you do that, you've crossed a line, and that completely changes everything. Seniorage will be the least of the concerns of the central bank. It will be core monetary policy transmission mechanism when you do that. So I think we would take gingerly steps, like Cecilia said, towards expanding the use of digital currencies within the banking system to remove some of these frictions in payments and settlements. And then pause, take a deep breath, and really try to understand, is there any compelling merit in moving beyond that to the non-bank public? Because that changes the equation quite dramatically.
So I think we've pretty much run out of time. I think the one big picture message that I take away from this is that we want to think about technology and finance as continuing to separate the activities. We saw it separate payment streams and risk a long time ago, and now we're seeing it separate activities that we once thought were joined together. And so we should never assume, I think, as the panelists have said, that some of the activities that we see as being provided jointly, that they will continue to necessarily be provided jointly, and therefore that the central bank's role has to remain the same as it is necessarily in regulating or in providing those joint activities. But please join me in thanking everyone and thanking the Bundesbank.